Hello, everybody. I'm your host, Eric Bird, here at StopStrugglingNow.com. And today I figured I would do an afternoon surprise because the Federal Reserve is doing what is expected of them. Wall Street says we want to see 75 basis points. We can live with that. We're going to talk about it, and I'm actually going to show the live stream, the Powell stream, and we're going to go over their statement in case you don't already know. They have determined what their basis points are going to be, and we're going to talk about that before the live that they're going to have in about 10 minutes. And welcome. Stop struggling now, gear. Check. And please like, subscribe, and click the bell below so you get the latest updates. Now, let's get to it. All right, before I get here, I want to again thank you for being here on this afternoon surprise. Let me know in the chat room. Let me know what you thought the Federal Reserve was going to increase the interest rate to. 50 basis points, 75 basis points, 100 basis points. And again, if you're here in the SSN Nation, please smash the like button. That's so the YouTube gods know that we have someone in the house. And also subscribe to the channel. Click the all notification bell. That would be greatly, greatly appreciated. Also, please notice there's more gear on the wall. You know where to get it. StopStrugglingNow.com. And we'll get into it. I want to show this on the screen right now. Remember, this was released about 45 minutes ago. I'm going to run their actual press conference. Again, it starts in about 3 minutes. Well, I'll keep an eye on that. But here is their press release, just so you understand, on the Federal Reserve website. So you guys can always get this information before they actually come out with whatever they're going to say. So this is why the stock market has already increased in value 30 minutes ago, 45 minutes ago, because that's when this statement was released. You can see 2 p.m. So 30 minutes ago, roughly. So therefore, you knew they were going to do 75 basis points. In fact, you guys know for the last week, I've been talking about what Wall Street says that's what they're going to do. That's their buddies. That's who they're trying to help. That's why there's a wealth inequality gap here in America, because those who have the money, remember, the top 10% of the wealthiest own 89% of the stock market. So therefore, there's a reason they listen to their buddies. All right. Now, notice right here, the committee decided to raise the target range for the federal funds rate to 2.25% to 2.5%, and anticipates that ongoing increases in the target range will be appropriate. So, you guys, that one sentence right here tells you all you need to know. Everybody who's buying a house, good luck, because home values are going to start coming down, because not only are they raising it 0.75 today, which means it's going to be in the 6.5% percentage for home mortgages interest rates. Not only that, they're going to raise again. So watch out. Next meeting, next month, month after, expect another, whatever Wall Street says we can live with, whatever they say, that's generally what's going to happen. All right. So they're going to raise some more. Just keep that in mind. So there's going to be times for the greatest transfer of wealth is coming. And I dropped a video earlier today about it. So let's get on to the screen. Let me make sure they haven't went live yet. Nope, they're still not. They're scheduled to be 2:35. Now, let me know what you guys are thinking, how this is going to affect everything. Gold, silver, precious metals. And I'm even including copper in this, right? Platinum, palladium, all of them are basically down. The prices have been manipulated. Now may be a good time to consider adding a little to your portfolio. That's all I'm trying to say. You guys understand this because you're part of the SSN Nation. And once again, let me see if anyone has seen anything in the house. All right. It's open to everybody. In fact, this live stream is I didn't even prepare it, quite frankly, because I said, you know what? Let me see what happens if I try to go live. We're also going to see if you can hear audio. So please participate. Let me know if you can hear audio from their feed. And I'm hoping, here we go. Powell's now coming in. So let's get to it. And I'll get to that screen and let's see what happens. Here we go. He just walked in the room. Let me get him added here. And this ought to be very, very interesting. Here it is, live. Let me know if you can hear this, please. All right?
Good afternoon.
Because I have background going on and I want to turn my mics off. So let me know if anybody's here, if you can hear this.
We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses.
Audio turned up.
The economy and the country have been through a lot over the past 2.5 years and have proved resilient. It is essential that we bring inflation down to our 2% goal if we are to have.
I'm going to turn my mic off. Let me know, you guys, if you can hear this.
Benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by 0.75 percentage point and anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we are continuing the process of significantly reducing the size of our balance sheet. And I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. Recent indicators of spending and production have softened. Growth in consumer spending has slowed significantly, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened, in part reflecting higher mortgage rates. And after a strong increase in the first quarter, business fixed investment also looks to have declined in the second quarter. Despite these developments, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 375,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, while labor supply remains subdued, with the labor force participation rate little changed since January. Overall, the continued strength of the labor market suggests that underlying aggregate demand remains solid. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 6.3%, excluding the volatile food and energy categories. Core PCE prices rose 4.7%. In June, the 12-month change in the Consumer Price Index came in above expectations at 9.1%, and the change in the core CPI was 5.9%. Notwithstanding the recent slowdown in overall economic activity, aggregate demand appears to remain strong. Supply constraints have been larger and longer lasting than anticipated, and price pressures are evident across a broad range of goods and services. Although prices for some commodities have turned down recently, the earlier surge in prices of crude oil and other commodities that resulted from Russia's war on Ukraine has boosted prices for gasoline and food, creating additional upward pressure on inflation. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing target range to 2.25 to 2.5%. And we're continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and evolving outlook for the economy. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. As the stance of monetary policy tightens further, it likely will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. Our overarching focus is using our tools to bring demand into better balance with supply in order to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We are highly attentive to inflation risks and determined to take the measures necessary to return inflation to our 2% longer run goal. The process is likely to involve a period of below trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Hi, Chair Powell. Thanks for taking our questions. Rachel Siegel from the Washington Post. I'm wondering if you can walk us through your thinking around the decision not to go for a full percentage point increase. We saw a ramp up after the May CPI report came in hotter than usual, and then obviously the June figure did too. Was there any discussion of a stronger hike at this meeting? Yeah, thank you.
Sure. So we did judge that a 75 basis point increase was the right magnitude in light of the data and in the context of the ongoing increases in the policy rate that we've been making. I'd say that we wouldn't hesitate to make an even larger move than we did today if the committee were to conclude that were appropriate. That was not the case at this meeting. There was very broad support for the move that we made. You mentioned the June meeting. We had said many times that we were prepared to move more aggressively if inflation continued to disappoint. And that's why we did move to a more aggressive pace at the June meeting, as we said we would do. At this meeting, it continued at that more aggressive pace as inflation has continued to disappoint in the form of the June CPI reading.
Thank you so much for taking our questions. Colby Smith with the Financial Times. As the committee considers the policy path forward, how will it weigh the expected decline in headline inflation, which might come as a result of the drop in commodity prices, against the fact that we are likely to see some persistence in core readings in particular? And given that potential tension and signs of any kind of activity weakening here, how has the committee's thinking changed on how far into restrictive territory rates might need to go?
So I guess I'd start by saying we've been saying we would move expeditiously to get to the range of neutral. And I think we've done that now. We're at 225 to 2.5, and that's right in the range of what we think is neutral. So the question is, how are we thinking about the path forward? So one thing that hasn't changed is that it won't change is that our focus is going to continue to be on using our tools to bring demand back into better balance with supply in order to bring inflation back down. That'll continue to be our overarching focus. We also said that we expect ongoing rate hikes will be appropriate and that we'll make decisions meeting by meeting. So what are we going to be looking at? We'll be looking at the incoming data, as I mentioned, and that'll start with economic activity. Are we seeing the slowdown in economic activity that we think we need? And there's some evidence that we are at this time. Of course, we'll be looking at labor market conditions, and we'll be asking whether we see the alignment between supply and demand getting better, getting closer. Of course, we'll be looking closely at inflation. You mentioned headline and core. Our mandate is for headline. Of course, it's not for core, but we look at core because core is actually a better indicator of headline and all inflation going forward. So we'll be looking at both, and we'll be looking at them at those both really for what they're saying about the outlook rather than just simply for what they say. But we'll be asking, do we see inflationary pressures declining? Do we see actual readings of inflation coming down? So in light of all that data, the question we'll be asking is whether the stance of policy we have is sufficiently restrictive to bring inflation back down to our 2% target. And it's also worth noting that these rate hikes have been large and they've come quickly, and it's likely that their full effect has not been felt by the economy. So there's probably some significant additional tightening in the pipeline. So where are we going with this? I think the committee broadly feels that we need to get policy to at least to a moderately restrictive level. And maybe the best data point for that would be what we wrote down in our SEP at the June meeting. So I think the median for the end of this year, the median would have been between 3.25 and 3.5. And then people wrote down 50 basis points higher than that for 2023. So that's, even though that's now 6 weeks old, I guess, that's the most recent reading. Of course, we'll update that reading at the September meeting in 8 weeks. So that's how we're thinking about it. As I mentioned, as it relates to September, I said that another unusually large increase could be appropriate, but that's not a decision we're making now. It's one that we'll make based on the data we see, and we're going to be making decisions meeting by meeting. We think it's time to just go to a meeting by meeting basis and not provide the kind of clear guidance that we had provided on the way to neutral.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said that your policy works through influencing expectations and that policy needs to be at least moderately restrictive, which means you need financial conditions to stay tight. Futures market pricing currently implies you will raise rates this year along the lines of your June SEP, but then lower them a few months later next year. Are these expectations consistent with the need to keep financial conditions tight in order to moderate purchasing power and bring inflation back to 2%?
So I'm going to start by pointing out that it's very hard to say with any confidence in normal times what the economy is going to be doing in 6 or 12 months. And so to try to predict what the appropriate monetary policy response would be, I mean, of course, we do that in the SEP, but nonetheless, you've got to take any estimates of what rates will be next year with a grain of salt, because there's so much uncertainty. These are not normal times. There's significantly more uncertainty now about the path ahead than I think there ordinarily is, and ordinarily it's quite high. So again, the only data point I have for you really is the June SEP, which I think is just the most recent thing that the committee's done. Since then, inflation has come in higher, economic activity has come in weaker than expected. But at the same time, I would say that's probably the best estimate of where the committee's thinking is still, which is that we would get to a moderately restrictive level by the end of this year, by which I mean somewhere between 3 and 3.5%, and that the committee sees further rate increases in 2023. As I mentioned, we'll update that, of course, at the September meeting, but that's really the best I can do on that.
You said inflation had been a little bit hotter than anticipated.
Wow.
Has your view of the
That's
terminal
crazy.
rate changed since June?
So I wouldn't say it was. I think we didn't expect a good reading, but this one was even worse than expected, I would say. I don't talk about my own personal estimate of what the terminal rate would be. I will write down that it's going to evolve. It's obviously it has evolved over the course. I think for all participants, it has evolved over the course of the year as we learn how persistent inflation is going to be. And by the time of the September meeting, we will have seen 2 more CPI readings and 2 more labor market readings, and significant amount of readings about economic activity and perhaps geopolitical developments. Who knows? It'll be a lot. It's an 8-week intermeeting period, so I think we'll see quite a lot of data, and we'll make our decision at that meeting based on that data.
Gina. Hi, Jarrell. Thanks for taking our question. Gina Smilik, New York Times. You kind of alluded to this earlier, but I wonder, in the event that you see several months of very weak headline inflation numbers because oil prices are coming down so much, but core inflation continues to be strong or even picks up, I wonder how you would think about that.
So it's hard to deal with hypotheticals, but I just would say this: we would look at both, and we'd be asking ourselves, are we confident that inflation is on a path down to 2%? That's really the question. And we'll be making, our policy stance will be set at a level ultimately at which we are confident that inflation is going to be moving down to 2%. So it would depend on a lot of things. Of course, as I mentioned, core inflation is a better predictor of inflation going forward. Headline inflation tends to be volatile. So in ordinary times, you look through volatile moves in commodities. The problem with the current situation is that if you have a sustained period of supply shocks, those can actually start to undermine or to work on de-anchoring inflation expectations. The public doesn't distinguish between core and headline inflation in their thinking. So it's something we have to take into consideration in our policymaking, even though our tools don't really work on some aspects of this, which are the supply side issues.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. Earlier this week, the president said we are not going to be in a recession. So I have 2 questions off of that. Do you share the president's confidence in not being in a recession? And second, how would or would not a recession change policy? Is it a bright line, sir, where contraction of the economy would be a turning point in policy, or is there some amount of contraction of the economy the committee would be willing to abide in its effort to reduce inflation?
Why would Biden say such a thing?
So as I mentioned, we think it's necessary to have growth slow down, and growth is going to be slowing down this year for a couple of reasons. One of which is that you're coming off of the very high growth of the reopening year of 2021. You're also seeing tighter monetary policy, and you should see some slowing. We actually think we need a period of growth below potential in order to create some slack so that the supply side can catch up. We also think that there will be, in all likelihood, some softening in labor market conditions, and those are things that we expect and we think that they're probably necessary if we were to have to get inflation, if we were to be able to get inflation back down on a path to 2%, ultimately get there.
The question was whether you see a recession coming and how that might or might not change policy. Thanks.
So we're going to be focused on getting inflation back down, and we, as I've said on other occasions, price stability is really the bedrock of the economy, and nothing works in the economy without price stability. We can't have a strong labor market without price stability for an extended period of time. We all want to get back to the kind of labor market we had before the pandemic, where differences between racial and gender differences and that kind of thing were at historic minimums, where participation was high, where inflation was low. We want to get back to that, but that's not happening. That's not going to happen without restoring price stability. So that's something we see as something that we simply must do, and we think that we don't see it as a trade-off with the employment mandate. We see it as a way to facilitate the sustained achievement of the employment mandate in the longer term.
Howard Schneider with Reuters. Particularly in regard to expectations, it's been said the last few months that the risks of doing too little outweighed the risks of doing too much. Does that remain the bias?
So we're trying to do just the right amount, right? We're not trying to have a recession, and we don't think we have to. We think that there's a path for us to be able to bring inflation down while sustaining a strong labor market. As I mentioned, along with, in all likelihood, some softening in labor market conditions. So that's what we're trying to achieve, and we continue to think that there's a path to that. We know that the path has clearly narrowed, really based on events that are outside of our control, and it may narrow further. So, you know, I do think, as I said just now, that restoring price stability is just something that we have to do. There isn't an option to fail to do that, because that is the thing that enables you to have a strong labor market over time. Without restoring price stability, you won't be able to, over the medium and longer term, to actually have a sustained period of very strong labor market conditions. So, of course, we serve both sides of the dual mandate, but we actually see them as well aligned on this.
But as a follow-on to that, given the uncertainty and the sort of paradoxical flow of data you've been getting, if you're going to make a mistake, would you rather make the mistake on doing too much, raising too much, than raising too little?
Yeah, we're trying not to make a mistake. Let me put it this way. We do see that there are two-sided risks. There would be the risk of doing too much and imposing more of a downturn on the economy than was necessary. But the risk of doing too little and leaving the economy with this entrenched inflation, it only raises the cost. If you fail to deal with it in the near term, it only raises the cost of dealing with it later. To the extent people start to see it as just part of their economic lives, they start to factor high inflation into their decisions. When that, on a sustained basis, when that starts to really happen, and we don't think that's happened yet, but when that starts to happen, it just gets that much harder, and the pain will be that much greater. So I really do think that it's important that we address this now and get it done.
Thanks, Chair Powell. Neil Irwin from Axios. To build a little bit on what Steve was asking, do you believe the United States is currently in a recession? Will the GDP reading tomorrow affect that judgment one way or the other? And has your assessment of the risk of recession changed any in recent weeks?
So I do not think the U.S. is currently in a recession. And the reason, there are just too many areas of the economy that are performing too well, and I would to labor market in particular. As I mentioned, it's true that growth is slowing, and for reasons that we understand. Really, the growth was extraordinarily high last year, 5.5%. We would have expected growth to slow. There's also more slowing going on now. But if you look at the labor market, you've got growth. I think payroll jobs averaging 450,000 per month. That's a remarkably strong level for this state of affairs. The unemployment rate at near a 50-year low at 3.6%. All of the wage measures that we track are running very strong. So this is a very strong labor market, and it's just not consistent with 2.7 million people hired in the first half of the year. It doesn't make sense that the economy would be in recession with this kind of thing happening. So I don't think the U.S. economy is in recession right now. Haven't seen it, and we'll just have to see what it says. I don't. I would say generally the GDP numbers do have a tendency to be revised pretty significantly. It's very hard. It's very hard to accumulate U.S. GDP. It's a large economy, and a lot of work and judgment goes into that. But you tend to take first GDP reports, I think, with a grain of salt. But of course, it's something we'll be looking at.
Well, let me know if you guys are buying any of this.
Victoria Guido with Politico. I wanted to ask about the new conflict of interest rules that you all rolled out. Some senators have written asking for those rules to have more teeth and to have sort of more transparency about the Fed officials' financial activity. I was wondering if you could speak to that and whether you intend on toughening those rules in any way.
So those are the toughest rules in place, at any comparable institution that I'm aware of. We think, we thought about this carefully, and we put them in place, and we're building the infrastructure so that the enforcement will be tight, that actually you won't be able to make trades unless they're pre-cleared. And the amount of trades you make will be, they'll have to be 45 days or more before any FOMC meeting. It's just, I think we've really, created a very strong and robust set of rules that will, support public trust in the institution. And again, we're just now, the system is just now up and running, and I'm proud of what we did.
Hi, Katerina Saraiva, Bloomberg News. I wanted to ask a little bit more about the 75 basis points versus 50 versus 25. Can you talk a little bit about what kind of goes into your thinking for, making the decision on how much to raise rates? And, just talking about a very large amount that you alluded to, could that possibly be 100 basis points? And then kind of along those lines, is there any sort of weakness in the economy outside of inflation measures that would lead you to slow your hiking pace?
So I'm gonna take that as a question about the next meeting and thereafter. So as I mentioned, we're going to be looking at all of those things: activity, labor market, inflation, and we're going to be thinking about our policy stance and where does it really need to be. And I also mentioned that as this process, now that we're at neutral, as the process goes on, at some point, it will be appropriate to slow down. And we haven't made a decision when that point is, but intuitively that makes sense, right? We've been front end loading these very large rate increases. Now we're getting closer to where we need to be. So that's how we're thinking about it. And we're, in terms of September, we're going to watch the data and the evolving outlook very carefully and factor in everything and make a decision in September about what to do. And I'm not really going to provide any specific guidance about what that might be. But I mentioned that we might do another unusually large rate increase, but that's not a decision that we've made at all. So we are, we're going to be guided by the data. And I think you can still think of the destination as broadly in line with the June SEP, because it's only 6 weeks old, and sometimes SEPs can get old really quick. I think in this one, I would say is probably the best guide we have as to where the committee thinks it needs to get at the end of the year and then into next year. So I would point you to that.
Chris.
Hi, thank you, Chris Rugaber. I wanted to ask about. Right now, there is a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings?
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does. And so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the of CPI, we are calling it out and notice we do target C. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time, and if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we, some 20 plus years ago, moved to PCE.
I'd like to weave a couple of things together, Mr. Chairman. Michael McKee from Bloomberg TV and Radio. You said that the destination pretty much remains the same in terms of your end of the year target, but where are you in the journey? We've now seen the federal stimulus programs, and you mentioned consumer spending, business investment have slowed. Are they moving at pace you would expect, or is demand still greater than supply, too much greater than supply, that you need to do significantly more? And I ask because there are lags in the impact of monetary policy, as you mentioned, and a lot of this might hit in 2023. The strong dollar effect may hit in 2023 when the economy might be weak. How do you know where you are and where you think you need to get to?
Well, just talking about demand for a second, as I mentioned in my remarks, I think you pretty clearly do see a slowing now in demand in the second quarter. Consumer spending, business fixed investment, housing, places like that. I think, people widely looked at the first quarter numbers and thought they didn't make sense and might have been misleading in terms of the overall direction of the economy. Not true of the second quarter, but at the same time, you have this labor market. So there are plenty of experiences where GDP has been reported as weak and the labor market is strong, and the economy has gone right through that and been fine. So that's happened many times. And it used to happen, if you remember, in the first quarter of every year for several years in a row, GDP was negative and the labor market was moving along just fine. And it turned out to just be measurement error. It was called residual seasonality. We don't know the situation. The truth is, though, we think that demand is moderating. We do. How much is it moderating? We're not sure. We're going to have to watch the data carefully. There is a great deal of money on people's balance sheets that they can spend. The unemployment rate is very low. The labor market's very hot. There are many, many job openings. Wages are high. So it's the kind of thing where you think that the economy should actually be doing pretty well in the second half of the year. But we'll have to see. We don't know that because you do see a marked slowing in the second quarter that is fairly broad. So we'll be watching that. We'll be watching that. Of course, as I mentioned, we do want to see demand running below potential for a sustained period to create slack and give inflation a chance to come down.
Nicole. Hi, thank you, Chairman. Nicole Goodkind, CNN Business. When does the committee expect to see a meaningful slowdown in the labor market, and how much weakness will it accept with regard to slower job growth and higher unemployment before it pauses or begins to think about cutting rates?
So I think you're already you've seen in the labor market, what you've seen is a decline from very high levels of job creation last year and earlier this year to modestly slower job creation, still quite robust, as I mentioned. So you're seeing that. You're seeing some increase in initial claims for uninsurance, although that may actually have to do with seasonal adjustments. We're not sure that that's actually real. There's some evidence that wages, if you look at average hourly earnings, they appear to be moderating. Not so yet from the other wage measures, and we'll be getting the Employment Compensation Index measurement, I think, on Friday, I guess. And that's a very important one because it adjusts for composition. So I'd say and also anecdotally, you hear much, the sort of level of concern on the part of businesses that they simply can't find workers is probably down a little bit from what it was, say, for example, late in the latter parts of last year. So there's a feeling that the labor market is moving back into balance. If you look at job openings or quits, you see them moving sideways or perhaps a little bit down. It's only the beginning of an adjustment. But I think most also, if you look at, once you start citing these things, you can't stop. If you look at the household survey, you see much lower job creation, and the household survey can be quite volatile, but it has no jobs created in the last 3 months. So that might be a signal that job creation is actually a little bit slower than we're seeing in the establishment survey. So executive summary, I would say there's some evidence that labor demand may be slowing a bit. Labor supply, not so much. We have been disappointed that labor force participation really hasn't moved up since January. That may be related to yet another big wave of COVID, and there's evidence that that's the case. But so we're not seeing much in the way of labor supply. Nonetheless, I would say some progress on demand and supply getting back in alignment.
How much weakness would you be willing to accept before you think about pausing rate cuts?
So I think we're going to be looking at at inflation as well. We, you know, as I mentioned, we need to see inflation coming down. We need to be confident that inflation is going to get back down to mandate consistent levels. That's not something we can avoid doing. That really needs to happen. But we do think, though, that the labor market can adjust because of the huge overhang of job openings, of excess demand, really. There should be able to be an adjustment that would have perhaps lower than expected increases in unemployment, lower than would be expected in the ordinary course of events, because the ratio of vacancies to unemployed is just out of keeping with historical experience, and that suggests that this time could be different.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So you said the path may be narrowed to avoiding a recession. So how close are we to a recession? And then how do forecasts of possible recessions from banks and economists, how does that make a soft landing you've talked about more difficult?
So as I mentioned, it doesn't seem that the U.S. economy is in recession right now. And I think you do see weakening, some slowdown, let's put it that way, in growth, and you see it across some of the categories that I mentioned, but there's also just the very strong data coming out of the labor market still. So overall, you would say that in all probability, demand is still strong, and the economy is still on track to continue to grow this year. But the slowdown in the second quarter is notable, and we're going to be watching that carefully. Sorry, what was the
Forecasts? How do bank forecasts of possible recessions, economies, does that affect the soft landing?
Well, we've said since the beginning, I think, that having a soft landing is what we're aiming for. Of course, that has to be our goal. It is our goal, and we'll keep trying to achieve it. I do think events. At the beginning, we said it was not going to be easy. It was going to be quite challenging to do that. It's unusual. It's an unusual event. It's not a typical event given where we are. If there is a path to it, and we think there is, it is the one I mentioned, that the labor market actually has such a large amount of surplus demand that you could see that demand coming down in a way that didn't translate into a big increase in unemployment as you would expect in the ordinary course, because frankly the imbalance is so much greater. But we don't know that. I mean, this is a case of first impression. So anyone who is really sure that it's impossible or really sure that it will happen is probably underestimating the level of uncertain thing. Nonetheless.
Jean Young with Market News. I wanted to ask about the balance sheet, and in a different environment than the last time the Fed did it. What are you learning about how it's working and how markets are reacting? And is reaching the minimum level of reserves needed in the system still several years away at the current pace?
So we think it's working fine. As you know, we tapered up into it, and in September we'll go to a full strength, and the markets seem to have accepted it. By all assessments, the markets should be able to absorb this, and we expect that'll be the case. So I would say the plan is broadly on track. It's a little bit slow to get going because some of these trades don't settle until for a bit of time, but it'll be picking up steam. So, and I guess your second question was getting, the process of getting back down to the new equilibrium will take a while, and that time it's hard to be precise, but the model would suggest that it could be between 2.5 years, that kind of thing. And this is a much faster pace than the last time. Balance sheet's much bigger than it was, but we looked at this carefully, and we thought that this was a sensible pace, and we have no reason to think it's not.
Hi, Chairman Powell. Brian Chung, Yahoo Finance. Looking at financial conditions, it seems like the tightening has slowed as of late, with the 10-year coming down, 30-year fixed mortgage rates also going a bit sideways when we talk about a hot housing market still Just wondering if you find financial conditions tight enough, especially as you continue to raise rates.
So a big piece of that is inflation expectations, break evens coming down, which, is a good thing. It's a good thing that markets do seem to have confidence in the committee's commitment to getting inflation back down to 2%. So we'd like to see market-based, readings of inflation expectations come down. Broader financial conditions have tightened a good bit. I mean, the way this works is we set our policy and financial conditions react, and then financial conditions are what affects the economy. So, and we don't control that second step. We're just going to do what we think needs to be done. We're going to get our policy rate to a level where we're confident that inflation will be moving back down to 2%. Confident. So that's how we're going to take it. And of course, we'll be watching financial conditions to see that they are appropriately tight and that they're having the effect that we would hope they're having, which is to see demand moderate and inflationary pressures recede and ultimately inflation come down.
Thank you, Chair Powell. Greg Robb from MarketWatch. I wonder if you can go back a little bit in time to before there was this outbreak of inflation, when the committee put in place forward guidance on tapering asset purchases. I think it was December 2020. There's a recent speech by Fed Governor Waller talking about that and saying that maybe that was too tight, that kind of condition, and it put you a little bit behind. Not his words, but maybe, we're kind of late to react to some of that inflation. So could you talk about that decision, and have you looked at it in hindsight at all? Thank you.
So yeah, we said that we wouldn't lift off until we had basically achieved our dual mandate goals. And the reason we did it in real time was that the first look at the new framework that we'd rolled out, plenty of people were saying, oh, it's not credible, you'll never get inflation to 2%. Some of our critics now who say inflation is too high were the same ones who were saying you'll never get to 2%. Well, but anyway, that's what happened. So we thought we needed to really make a strong statement with that. It wasn't part of the framework. The December 20 guidance was not part of our overall new framework. It was just guidance that we put in place. So I would say two things. One, I don't think that has materially changed the situation, but I have to admit, I don't think I would do that again. I don't think I would do that again. We, ultimately the situation evolved in a highly unexpected way for all of us. And, maybe the learning is that leave a little more flexibility than that. But did it matter in the end? If you look at, I really don't think it did. I'm not sure it would have mattered if we'd been raising rates 3 months earlier. Does anybody think that would have made a big difference? I mean, lots of central banks were raising rates 3 months earlier, and it didn't matter. I mean, this is a global phenomenon that's happening now. Admittedly, different in the United States, but anyway.
Just a lot of people talk about that time, and they talk about a taper tantrum that I know you haven't talked about it too much, but that you were worried at the time about repeating that taper tantrum that you had experienced as a governor. So was that part of that? Where did that fit into all this? Thank you.
So I think we learned there have been multiple taper tantrums, right? So there was the famous one in 2013. There's what happened at the December 18 meeting where markets can ignore developments around the balance sheet for years on end and then suddenly react very sharply. So we just had developed a practice of moving predictably and doing it in steps and things like that. It was just like, that's how we did it. And so we did it that way this time. We were careful to take steps and communicate and all that kind of thing. We were trying to avoid a tantrum because they can be quite destructive. They can tighten financial conditions and knock the economy off kilter. And when it happens, you have to really, in both 13 and 18, really had consequences for the real economy, 2, 3, 4 months later. So we were trying to avoid that. That was part of it. Again, I don't think that's the real issue of 2020 and 21 was just trying to understand what was happening with the reopening economy. That was where the big uncertainty was. And our view was that these supply side issues would get better, that people would go back to work, that labor force participation would come back, everyone would get vaccinated, schools would open, kids would be in school, and labor force participation would jump back up. That's what that was very broadly thought to be the case. These supply side issues would get solved reasonably quickly, and they just haven't. They still haven't. So that's really the learning, I think, is around how complicated these supply side issues can be. We haven't seen this before in a long, long time. And so that's really what accounts for the pace at which we moved. And, we did, when inflation changed direction really in October, we've moved quickly since then. I think people would agree. But before then, inflation was coming down month by month. And, we kind of thought we had the story, probably had the story right. But then I think in October, you started to see a range of data that said, no, this is a much stronger economy and much higher inflation than we've been thinking. And again, we pivoted and here we are.
Nancy Marshall-Genzer with Marketplace. Chair Powell, I just want to pin you down a little bit more on the issue of recession. So if we get a negative GDP number tomorrow for the second quarter, would the Fed consider the US in a recession? And just remind us, what is your definition for the start of a recession?
So the Fed doesn't make a judgment on that. We're focused on the dual mandate and using our tools to achieve maximum employment and price stability. We don't say there is now a recession, that kind of thing. So that wouldn't be something we do. We would look at the data tomorrow, and no doubt we'll look at it very carefully and draw whatever implications we can. As I mentioned, though, if you think about what a recession really is, it's a broad-based decline across many industries that that's sustained for more than a couple of months, and there are a bunch of specific tests in it, and it just doesn't seem like that now. What we have right now doesn't seem like that, and the real reason is that the labor market is just sending such a strong signal of economic strength that it makes you really question the GDP data. But again, that's not a decision that we make, and we won't reach a conclusion one way or another on that.
Thank you very much, Simon Rabinovich with The Economist. You've said that some softening in the labor market is needed. Within the Fed, there are staff economists who've argued that Nairu, the non-inflationary rate of unemployment, might be as high as 5 to 6% right now, which obviously is a lot higher than the current rate of 3.6. What's your assessment of Nairu? Is that something that came up in discussion with the committee?
So I think broadly, a lot of economists think that the natural rate of unemployment will have moved up to some significant extent above where we think it was before. And the reason is it's the usual matching issue where matching has become less effective and that kind of thing when you have the kind of turbulent downturn and the big switches in demand from services to goods and all that. So it could be higher, and my own instinct is that the natural rate of unemployment is higher. Of course, I would add that we don't know it. We can never know where these star variables are in real time with any confidence, but I would say it must have moved up materially. But the other side of that is as all these jobs get created and people go back to work and unemployment is so low, I think you could, in principle, you could see it coming back down pretty significantly. And that would also, by the way, take pressure off of inflation, because it's that gap. It's the gap between actual unemployment and the natural rate that really is relevant for the negative slack we have in the economy by the overtight labor market. So if you wouldn't observe this. It's an unobservable, but you could actually be seeing inflationary pressures coming down if that does happen. And we don't control that, but that's something that logically. If the pandemic and the disorder in the labor market cause the natural rate to move up, the labor market settles down. In principle, you should see it move back down.
Thank you, Chair Powell. Jeff Cox from CNBC.com. Just a question about, hate to keep banging the drum about recession, but most of the polls that we're seeing now from the public, people believe that we're already in a recession or heading for one. Economists pretty much the same thing. They're being told by folks like you and in the administration that we're not in a recession, we're not heading for a recession. Frankly, coming from the same people who told them that inflation was transitory, telling them now that we're not heading for a recession. So what would you tell the public to reassure them now that you feel confident in your forecast going forward and the Fed is ready to respond to
exactly
a potential
transitory
downturn in the economy?
inflation? Yeah, okay.
No, all I've really said is I don't think it's likely that the U.S. economy is in a recession now. And I've explained why that is the case. It's because you do see a very strong labor market, and I think the public will see that as well. Going forward, what we've seen is a slowing in spending, as I mentioned. We've seen the very beginnings of perhaps a slight lessening in the tightness of the labor market, but it would only be the beginnings. So, and I mentioned that I also said that our goal is to bring inflation down and have a so-called soft landing, by which I mean a landing that doesn't require a significant increase, a really significant. We're trying to achieve that. I've said on many occasions that we understand that's going to be quite challenging, and that it's gotten more challenging over recent months.
Thanks, Chair Powell. Kyle Campbell with American Banker. The FOMC has historically tried to avoid the kind of rapid monetary policy tightening that has happened so far this year. How concerned are you that the rate hikes that we've seen thus far might increase risks to financial stability, not just domestically, but globally?
I mean, there are precedents for the FOMC moving very quickly. For example, 1994, 1980, even more so. So we've been known to do that when it's the appropriate thing to do, and this year it clearly is. I would say that given how quickly we've moved, I'm gratified that while that basically markets have been working, they've been orderly. There's been some volatility, but that's only to be expected. For financial stability perspective, asset values are down, which in some sense lowers vulnerabilities. It's when they're really high that you would worry that they're vulnerable to a fall. Actually, many asset values have come down. I think you've got a well-capitalized banking system. I think you have households are generally in about as strong financial shape as they've been in a very long time, or perhaps ever, given what the money that's on people's balance sheets. And so you have from a financial stability standpoint, you have a pretty decent picture. Now, there are plenty of macroeconomic issues that don't rise to the level of financial stability concerns. By financial stability, we think of that as things that might undermine the working of the financial system. So big, serious things. That's not to say that people at the lower end of the income spectrum aren't suffering, because they are. They're suffering from high inflation. They're going to to the grocery store and finding that in many cases their paycheck, it doesn't cover the food they're accustomed to buying. We're seeing actual real declines in food consumption. It's very concerning. It's very unfortunate, and that we're really committed to bringing down inflation. One of the reasons.
Go to Mark for the last question.
Thank you, Mr. Chairman. Mark Hamrick with Bankrate. I can remember when you held your first news conference and you vowed to be a very plain-spoken chairman. And we're thinking today about the impacts of Fed policy on individuals as well. What would you say to individuals or households who may yet lose their jobs in this tightening cycle in the fight against inflation as they try to translate what Fed policy means to them in this complicated economic landscape?
Yeah.
Thank you.
So I guess the first thing I would say to every household is that we know that inflation is too high. We understand how painful it is, particularly for people who are living paycheck to paycheck and spend most of that paycheck on necessities such as food and gas and heating their homes and clothing and things like that. We do understand that those people suffer the most. Middle class and better off people have some resources where they can absorb these things, but many people don't have those resources. So, it is our job. It is our institutional role. We are assigned uniquely and unconditionally the obligation of providing price stability to the American people. And we're going to use our tools to do that. As I mentioned, there will be in all likelihood, some softening in labor market conditions. We need growth to slow to below potential growth. We don't want to, we don't want this to be bigger than it needs to be, but ultimately, if you think about the medium and longer term, price stability is the thing that makes the whole economy work. It's what can give us a strong labor market and wages that aren't being eaten up by high inflation. If you talk to people, again, people who are making wages, relatively low wages, they're the ones who are suffering the most from inflation. So it's all the more reason why we need to move on this. Thank you very much.
All right, ladies and gentlemen, this right here is crazy. Let me know what you think about what Jay Powell is talking about here. This is out of control, what they're doing to the United States middle class and lower income class. This is straight BS. It makes me livid. This is why I started the Stop Struggling Now channel, the SSN Nation, because of stuff like this. People are hard at work right now. All they know is that they're going to be getting terms and condition changes. They're going to get things in the mail talking about we're going to increase because your interest on your credit cards or interest on your loans is based on prime plus their federal funds rates. So therefore, they don't know anything about this. Then they hear these snippets that Jay Powell's going to talk about. In fact, I took a couple of notes where he started going, higher prices means inflation. And so we're going to be able to get it under control. He's trying to equate higher prices equaling inflation, when in fact, that is not the case, ladies and gentlemen. Inflation is based on the fact that you reduce the value of the dollar. So when I'm out here and I'm just going to play the simple game of Monopoly that you guys know that I love to talk about, and I'm sitting here at the end of Monopoly, I own most of the buildings. Everybody has landed on my property, so I have all the money. Those people are looking, going, man, we can't play anymore. But imagine if those were the banks and those are the companies that were getting bailouts. So now the Federal Reserve comes in and says, hey, man, you guys are still in the game. We're just going to give you the same amount of money that you started with. And the guy that has all the money is going to look at them like, what are you talking about? That now means we have, if there's 3 players, we have just 2 times the money supply, which now means the value of the money just decreased. That's what they're doing. And of course, the prices have to go up, because now when you land on my property, and it used to be $500 for landing on my property, I'm going to charge you more. I'm going to say, no, it's $800 now. So that's why there's inflation. And so when you're giving people subsidies like the gas, the oil, the Walmarts, the Amazons, the Teslas, these big ass Apples, Microsoft, all these companies using our taxpayer money, that's also increasing. You're giving people money, and then they're going out here buying yachts, boats, planes, getting new corporations being built. That is actually not helping. All right. So again, he's talking nonsense. You can go to any school. There's a ton of junior colleges, even high schools, if they talk about economics. You can just walk in and listen to any professor, any subject matter where they start talking about how inflation occurs. Inflation occurs when you decide to sit up here and say, you know what, I'm going to give tax cuts and tax breaks to the top 10%. So you're funneling money to them. And then they turn around and go, haha, thanks for the money. We're going to raise our prices. That's not inflation because they raise their prices. It's inflation because you're transferring wealth. You're transferring money from the poor and middle class up to the rich. And then when you go, hey, man, can I get a raise? Inflation went up 9-10% this year. And they look at you like, have you lost your mind? You get paid $20 an hour. We're not going to go up to $22 an hour. We're not going to go up to 25 an hour. They're not going up to 30 an hour. So again, this gets me livid, ladies and gentlemen, with this nonsense. Basically, they're robbing the middle class and lower income classes blind while he's standing up there with a straight face talking nonsense. And they're all along quantitative easing, transitory inflation. What the hell? They're printing money out of thin air and giving it to their buddies so they can buy more shares of stock. That's what's inflating the stock market. That's what inflated the real estate market. And so now they have to raise the interest rate, and then in the return, they're acting like they don't know what's going on. Come on, this is not rocket science. I'm going to drop the interest rates down to damn near zero. Obviously, real estate prices are going to go up. They're going to skyrocket. Who's that going to benefit? It's going to benefit the wealthy who already has homes, who have the $500,000, $600,000 homes, and now they're worth $1.5 million, and they have all this equity. But now all they're doing now is, after they inflated the bubble, increase the middle and upper middle income classes to be able to get more assets via loans. Now they're going to deflate the bubble, and all those people who have all this money are going to be able to buy not one, but maybe 2 or 3 houses for the same price that they used to be able to buy one. But who's going to have the money? You're not getting a raise. You're not going to get, if you get $30 an hour, they're not going to walk in and say, hey man, you know, due to gas prices, due to groceries, it's going to be $35. Anyhow, that's why I started this. And that's also why I started, you know, my favorite baby, SSN Lifestyle, ladies and gentlemen. I have links down below for everything. All right. SSN Lifestyle. In fact, let's talk about this since Jay Powell's giving a bummer. Win tickets to the Coke Zero Sugar 400 and the Wawa 250 car races in Daytona Beach, August 26th, 27th. How do you do that? The link is down below, SSN Lifestyle. You know something else he talked about? This is so maddening. He started talking about there is no recession. I'm like, what planet are they on? This is insanity. So the definition of a recession is literally when the United States has 2 quarters of negative GDP growth. All right. Now, earnings have come out. It's the end of July. These companies are saying they have revenues have decreased. A lot of the companies. We all know this. But for whatever reason, the fact that Biden comes out and starts talking crazy, right? He's even listening to Jay Powell talking about, oh, don't worry about it. Don't worry about a recession. I'm like, how are you saying this? You guys printed up damn near 50% of the money supply since 2017 to 2021. 50% of the money supply has been added because out of thin air. So that tells me inflation clearly has to be 50% over this time span. It's been literally 20% the last 2 years, but they're telling people 8%, 9%, 10%. All right, this is insanity. And this is just so they can manipulate you. So therefore, you're walking through life going, oh, ho hum, and then you're going living paycheck to paycheck, which is damn near 70% of the American population. It kind of correlates with the top 10% owning as much as the bottom 70% in wealth combined. The bottom 70%, 210 million people own just as much wealth as 35 million people. Come on, something's not right there, is it? 35 million people own as much wealth as 210 million. That's a problem. That's wealth inequality, ladies and gentlemen. All right. And so therefore, we have to actually make more money just to keep up. So when you used to be able to buy a house in the 70s for 15 grand, 25 grand, 40 grand, now homes are $450,000, 10 times your money. But the funny thing is, think about this. Minimum wage. Let's say in the 70s, minimum wage was a little lower, but let's say it went up in the late 70s to $7.50. If a house cost 10 times as much as it did back then, How come the $7.58 isn't $70.50 an hour? If we go by inflation, if we go by the average cost of homes, that's what I'm talking about. You're getting wiped out, ladies and gentlemen. And that's why, again, I'm very happy. That's why I started this SSN lifestyle, because I'm trying to do something that is unheard of. Because, again, I have the links down below. Group economics, where you can invest where they don't block you, where they sit there and say, oh, you want to get in on an IPO? Oh, I'm sorry. Do you have $1 million of assets? Do you make $250,000 a year? They start putting all these parameters in, like the guys that can get in that have all these assets and make this amount of money, like they're smarter than everybody else. Why is it that they won't let somebody say, hey, you know what? I want to get in, and all I have to put in is $1,000 or $500 or $2,000 or $10,000. Why can't I get in? The reason why you can't get in is because they know it's going to go IPO. What is it going to look like if you have ordinary citizens, the bottom 210, and all of a sudden these guys are able to conjure up a few $50 million combined together in an investment pool, then they're able to buy stocks, the pre-IPO, for 50 cents, $1. And then when they come out on the IPO market, it's $120 a share. That would be trillions of dollars, ladies and gentlemen, in the hands of the lower 70%. That's why they block it. All right, let's get on with it. This made me sick today, to my stomach. No recession, strong labor market. Is there anybody here that can explain to me what a strong labor market is? Please explain. Because I want his definition of what a strong labor market is. Because I'm going to tell you right now, if there's all these jobs anywhere from $7, and if you work in a service industry, you can be making, from what I understand, $3 an hour because you get paid in tips. But nonetheless, we'll stick with basics. Let's call it minimum wages, $7.80. I don't know what it is. Now, there's no way a person can live on that, so nobody's going to take that job. If the job pays $10 an hour, you can have all the openings you want. Nobody's going to take these jobs. If they go to $15 an hour, nobody's going to take these jobs. If they go to $20 an hour, nobody's going to be anxious to sign up. It costs $600, $700, $800 a week in some cases for childcare. So how is this going to work? Hey, let me go through some of this stuff, man. Let me go through some of this stuff. They're scared of that R word. Exactly, Moses Tillman. Except that's why they're going to have to manipulate the what's going to about to happen in 5, 6, 8 days when they manipulate the numbers. They're going to have to say, no, the GDP is higher than what it was the last month. I think that's what's going to happen, but I don't see how. It's going to be unavoidable. So there will be 2 quarters, and that's recession. They're sitting out here talking about a recession in 2023. And now I'm sitting here listening to him like, there's no recession going on. We're raising the interest. How is there going to be a recession in 2023 if you already are sitting here saying there is no recession now? And then you're correlating, trying to say a strong job market stops inflation. What are they talking about? A job market has no bearing on frickin' inflation. This is all word salad because people don't understand economics, because they pull the rug out of education in schools and colleges like they shouldn't have done. So that's why people are out here going, oh, Jay Powell said. In fact, I got a friend of mine that we got into it sometime last year when my friend started spouting the same kind of nonsense. He started going, oh, man, don't worry about the inflation. It's no big deal. As soon as people are able to go to work and buy stuff and do, I was like, buy stuff? The prices are already going to be increased. What are you talking about? It doesn't matter about if people have jobs. The money's already been printed out of thin air. It's irrelevant. You've already reduced the value of $1 every time you print money out of thin air. Every time you come out with a new bond, every time you do all this crazy buying up people's debts, bailing out people. I'm like, what are you talking about? I said, okay, I'm going to put it right now. Inflation, when me and him was talking, inflation was something like 4 point something percent. I said, okay, Talk to me in 6-8 months when it's double this number. Are you still going to tell me when you have less people working, you have people making the same amount of money? What's your explanation then? I said, so what? You're going to have the same amount of people out of work. You're going to have the same amount of everything. Explain to me then how inflation is going to get higher. And sure enough, it's doubled. And actually, we already know it's more than double. So I get tired of listening to this nonsense, ladies and gentlemen, belly dancing and those questions. Exactly. I get tired of it. Got you. Yep. If they continue like this, it will be the depression word they will have to deal with. Exactly, Auntie Val. This little 0.75 nonsense, this we'll figure something out at September nonsense. All of that is BS, ladies and gentlemen. You're getting wiped out. Get yourself some gold, silver, precious metals while it's still cheap. Not a lot of it, just a little bit. All right. This is going to have to be a hedge against inflation. They've already infiltrated the crypto markets. So crypto's going to have a good day. Why? Because Jerome Powell and his buddies listened to his other buddies, Goldman Sachs, JP Morgan, and all the rest of them. And they said, hey, you know what? We love that 0.75 basis points, even though it should have been 1.5 basis points. This is so sickening. And you know who's getting wasted right now is the middle class and lower income. We're the ones getting wasted, ladies and gentlemen, because when you go to the store shopping, prices are going to increase. And some of you may not be thinking about the other factors that fall into play here. Let me ask you something. I'm just going to ask you. You are a major corporation, let's say, and you are on the Federal Reserve payroll. Right? So we used to be able to borrow at 1% from the Federal Reserve. The Federal Reserve, now we have to borrow at 1.75. All right? We have a problem because, you know, when we borrowed money from you before, we bought up our own shares of stock. Then we used our stock as collateral to borrow and buy up some more assets from somewhere else. We can't pay it back in the first place because we don't have the revenues to pay it back. That's why you bought up our debt in the first place. Where's this money coming out from? It's coming out of thin air. So there is no such thing as the prices are making inflation. They are making inflation. You got to understand this, ladies and gentlemen. This is why the wipeout is occurring. Sneakily, we're being wiped out. And sneakily, we're sitting there going, the next bubble that occurs after they have to deflate this bubble, because that's why they're going to have to increase the interest rates again. They have to make this go down, and they got to get the rates up high enough. 6.5 or 6.25, whatever it is, that's not high enough. It's got to get into the 8s and the 9s. So this is why Powell, on the other hand, goes, oh, well, in 2023, we're going to continue to worry about that and probably going to increase the rate. Of course they are. The reason why you have to get it up to the 9 is because we need housing prices to drop 50, 60%, is my opinion. Most people think it's going to be 30 or 40. I think 50, 60. Why 50, 60? Because then their buddies are going to be able to go on a warpath and buy up all these properties because they know the mother of all wealth transfers are going to come down next, because they're going to reduce the interest rate back down to 1%, 2%, 3%. So now that's going to increase the values. And if you think home prices were off the charts this time, what do you think is going to happen next time? Double the price from 50 and then double that potentially. All I'm saying, they're wiping out and making sure that there's an advantage for the rich and the wealthy, or corporations for that matter. All right. If they continue like this, it'll be the depression. Yes, me and Gino Scimmiente have said that we're talking about a depression. So again, ladies and gentlemen, thank you so much for being here. And again, there's links down below. If you want to get into a passive income opportunity where you earn 5% down to 0% every week, I can't give you an actual number because it's group economics, it's group funding, but $5,100 total. You can only put in anywhere from $100 to $2,500. It's capped. because I wanted to leave room because somebody might say, I'll put in 5,000. I didn't want that. I wanted to be able to get other people in there. The link is down below with SSN Lifestyle. That is the sister of SSN Nation, which is here. SSN Lifestyle is being created by me to help everybody, because you guys, if you don't have any ways to make extra streams of revenue, at least at SSN Lifestyle, you can have a free membership, and then you can refer people to products like this. All right. Bone and joint support. That's a product. We have another one, Body Balance Cream. This is for health. Health is needed. This actually helps. Not this product, but our Body Balance actually helps with your mental state, mood swings. It helps with depression. It helps with your blood pressure. It helps with a lot of different things. Magnesium, iodine. It helps with your thyroid balance. It's a cream, ladies and gentlemen, and priced right. Not like normal places that would charge $75 because there's memberships involved. It's in $34.99 is our Body Balance. The next one down that I just showed you, the bone and joint support cream, that is $27.99. D3 and magnesium is $19.99. All reasonable. And if you're a member and you refer other people, you receive commissions. So you'll always be able to make money, ladies and gentlemen, is the point at SSN Lifestyle. And I have links down below to get your free shares of stock from Robinhood and Webull if you haven't already. I have links down below for other items below this video in the description. So again, please join us tonight at 8:50 p.m. Eastern Standard Time. It's a live stream where members who have the icon like Professor Auntie Val here can be in the chat room. Everybody else tonight, you can only watch. Like right now, anybody can be in the chat room, whether you're a member or not. But tonight, during that live stream, every Wednesday, it's members only that can be in the chat. And members are also could be on the live stream with me if they prefer. You don't have to show your face. You can opt to have an avatar or an icon. Just don't show your webcam, and then an avatar will come up. But that's on Wednesdays. Monday and Friday open to everybody, but Monday is 8:50 p.m. Eastern Standard Time, and Friday is 9:10 p.m. Eastern Standard Time. All right, ladies and gentlemen, I got some feedback from you, and I greatly appreciate it. But again, this nonsense that they're spouting is just absurd. Again, I want to go over some stuff that I kept. So we are lying about recession, and we'll cook the books to prove it. Exactly. That's what they're going to be doing, ladies and gentlemen. They've always cooked the books. Who in their right mind believes inflation is 9%? If anything goes up 10%, that's already more than 9%. And you go to the grocery store, which is the number one thing everybody has to eat. You go there, you see boxes are getting smaller, but they're charging you the same amount of money. You see prices on the shelves are going up. It's not like rocket science, more than 10%. Something that was $4 a year ago is $6 now. That's more than 10%. Otherwise, it would have been $4 still, $4.20 to $4.70, not $4 something to $6. That's more than 10%. All right. I mean, I don't know what they're doing. Is anyone shocked that they did 0.75 rate increase? That's what I was asking everybody. I wasn't. We talked about this the other day on a live stream, and I dropped a video today. The reason why is because I showed on the Reuters where Wall Street was saying, okay, guys, 0.75 basis point, that seems like it would be good. If it's 1%, that could be catastrophic. That right there told me it's 0.75. We knew that, right? We all knew that. That wasn't going to be a shocker. And then, of course, just like Auntie Val, Professor Auntie Val said, nah, not brave enough. She's exactly right. All right. Moses Tillman says, BS, you're not on here every day in these streets. And that was in response to Jerome Powell talking about, oh, don't worry about it. We got it under control, kind of. We're going to do this, that. And then he responded with BS. You're not on here every day in these streets. He's not. He probably has somebody go buy their food. He probably has somebody that he drives around in a government vehicle that somebody else is putting gas in. So they're oblivious to how much things cost. And especially when you make a few $100,000 a year, you don't have to worry about, okay, the gas, it was $75. Well, you don't even know nothing about it. Somebody else filled it up. Use your corporate or federal credit card. Come on. This is crazy. And then, of course, he started talking about this. Wages are high. Just like Moses Tillman says, wages are high in what city? Again, what the hell are they talking about? You know how many people make $30 an hour and up? Come on. And then It's not like 200 million people make $30 an hour and up. It's not even 100 million. It's not even 50 million. I mean, this is ludicrous what they're talking about. And when you start talking about $30 an hour, 30 times 40 is only 1,200. After taxes, what is that? $1,100 every week, 4,500. That's 45,000 a year. What are they talking about? What high wages? What is he visiting New York? Is he visiting Silicon Valley? Is he visiting his friends in Beverly Hills? What is he talking about? Somebody down below. I mean, let me know. Let me know who's making $50 an hour or more to make this make sense. 50 times 40 is 2 G's a week. That's 8 G's gross a month. 8 G's gross a month is 96K. 96K, take away 20%, 18 G. That's 70 some G's. I mean, yeah, it's around 78 or 80 G's. We'll go 80 G's. That leaves you with around $6,500 per month. What high wages is he talking about? Obviously, he's hanging out with his buddies that make $200,000, $300,000, $500,000, $1 million a year. If that's because I don't know hardly anybody that's making $50 an hour unless you work in certain industries. All right, let's get real. This is absurd what they're talking about out here. What high wages? Yeah, I mean, like, come on, man. This is so disgusting. Here we go. And he was responding to then avoid bailing out the top 10%. That might help. Exactly. Exactly. 2.3 trillion for tax cut, tax breaks. Not cool. Then, of course, somebody goes, hey, we got to tackle infrastructure. And so we're going to try and build back better. Now, I like that plan, except you have people going, no, don't use 2 or 3 trillion, just use 1.5 trillion. I'm like, have you been to the bridges all over the United States? Those alone are going to cost you $1 trillion to handle. So we need more, except there's one little problem. America is negative. They have a deficit. That means any money, they have to print it out of thin air, which now devalues the money we have in the money chain already. You have to understand this, ladies and gentlemen. Let me know what you guys are thinking. All right? Let me know. I had to keep those little topics right there under lock and key I wanted to talk about after this. If you look at the markets right now, they're all green right now. Of course they are. Of course they are. They did exactly what they were supposed to do. That's why I knew 0.75 was coming. It's for their buddies. They already have a playbook behind our back where they get to make more money. We already knew this was coming. We knew it. He was just using big words to throw you off, just talking in a circle. Exactly, Moses Tillman. Exactly. And then redefining what things are. Inflation equals higher prices. I'm like, since when? The higher prices are a result of your inflationary tactics, like printing money out of thin air, giving companies bailouts, buying up companies' debts, allowing them to rebuy their own shares of stock, then turning around and saying, hey, can I get a loan against those stocks that I just borrowed to buy? Of course, the stock price goes up. It has nothing to do with prices going up because it's a free market. It's going up because you're manipulating it. Just like you're manipulating the real estate market when you go out here and give these guys loans for hundreds of millions or $25 million. They go up here and buy neighborhoods, and all they do is buy 2 homes and pay overpriced. People are sitting there going, man, every time I come in and make an offer, I can't win. I give the guy his full asking. I get something back talking about they said no. Then you find out, hey, how come? Okay, I love the house. I think it can work. I'll pay an extra 30, 40,000. They come back, no. It's because those guys that are able to get free money, free loans, they don't care what the price of the house is. They just go, we'll buy it for $100,000 more. Reason why? Free money. They bought it for $100,000 more. The other person now who was going to buy it at 400 can't qualify for 500,000. So think about it, ladies and gentlemen. This is very diabolical. They just bought 2 houses for 500,000 in the neighborhood. That means that increased the value of everybody's home, right? And any new buyer now, instead of only having to make 140,000 a year, now has to make 175,000 a year. But that's not the diabolical plot. The diabolical plot is they didn't just buy 2 homes. They bought 15. And then the 16th and 17th home, they increased the value $100,000. So therefore, the other 13 homes just went up in value $100,000. We just increased on paper $1.3 million. Now we can go out and use it as derivative and borrow against that 1.3 million, because why? You guys are going to give me some more free money where interest is going to be 2%, 2.5%, 1%, because I'm borrowing directly from the Fed. We're all friends, right? Now, not only that, now people move in, and now all the homes are now worth 500,000. Now people move in and they go, hey, the rent in this neighborhood used to be $1,500 a month. Oh yeah, but now corporations own it, and the rent is now 3 G's a month. You market it, you put the price up now where people now have to make $175,000 or more, so that limits the buyers. That turns those people that were 400,000 buyers into renters. Now the renters have to pay more than what the mortgage would be because they can't afford to buy homes in the neighborhood for $500K. Diabolical, ladies and gentlemen. Diabolical. And so when this whole housing price comes down, this is why they're not doing the 1% or 1.25% like they should. Because remember, their friends bought all these houses for 500. Now they overpaid for houses, inflated the housing prices. And this is why they can't afford for these homes to go down 20, 30, 40%. Because remember, most of these guys have borrowed against this asset class, and they might have borrowed somewhere in the neighborhood of 40 to 50%. So therefore, there has to be this margin where the price can't drop 50%. But soon as it starts dropping 30 or 40, all of a sudden they got problems, because now all of a sudden they're like, wait a minute, that derivative, that loan that we gave you against those assets, you got some money to put back in here or something, because we're getting a little scared. This is why they're not stepping on the gas, because they don't want their buddies to be losing. 50% is catastrophic. That means their margin calls, their loans are getting called. Those collateralized loans are getting called. That's what I'm talking about. You guys got to think about what's going on here. We're in the crossfire. There's not a damn thing we can do because we don't control government. But there is something you can do here on the ground. That means when it does drop 50 to 60%, like my prediction says, you better pounce on any properties that you can buy up. That's all I'm going to say. However you can do it, get as many as you can, whether it's multifamily. Multifamily is different. That always has a value because it's based on the actual rent rolls. I'm talking about single family housing at this point. The reason why you're going to be able to do what the big boys do, if you can get 4 or 5 properties, imagine you can buy something right now. Let's just say the house is 500 grand, and let's say it goes to 250. If you were able enough to get something all together, 5 homes, 1.25, can you imagine after the next inflationary bubble when that $500,000 house is going to be 1 million, and now you have 5 $1 million homes that you bought all together for 1.25? This is how the transfer of wealth is going to happen, ladies and gentlemen. Not using any money, not using any war, not using any guns, not using anything. They're going to do it that way. And the same thing's going to happen with the stock market. Remember, they have an endless supply of money, except there's one little problem that's on the horizon. There's countries, Russia, China, all these countries around the world, they're trying to bypass the US dollar as the world currency. And that is major. When that comes knocking at the door, the United States can't print up money anymore. And they're going to be treated like the third world country that they're printing up money like. We have a situation that's going to be depressionary, and you're not going to be able to get out of it no matter what. And this is why I've been sitting here talking about pre-construction outside of the United States, getting yourself some property, not on American soil. The reason being for that is if you ever need to go someplace, you have a place. They'll give you residency. You own property in that country versus just showing up and saying, hey, I need some asylum from the United States. That ain't going to work. Oh, I need to hang out here because it's cheaper. That will not work either. So this is what I'm saying. You better get a playbook together. And you guys here in the SSN Nation, you've had the playbook all along. You didn't know 4 years ago what the venture was going to be, but there was always a playbook. And I never told you the playbook, but you guys have everything, all the knowledge, all the information where you could say, hey, what happens if America falls down? What are you going to do? I'm just saying, what if America's like Mexico? Which it kind of is. They have cartels here too. We have a government cartel. We have interagency cartels. We have actual drug cartels in America, religious cartels, government party cartels, all looking out separately for themselves. This could go down very bad. All I'm saying is you got to prepare for the bad, prepare for the worst. Whether it happens or not, at least you'll come out ahead regardless. But again, check the video that I dropped earlier today. It was based on this fact. All right. So I'm going to get off here, ladies and gentlemen. I just wanted to see what would happen if I ran midday and I actually just impromptu put in a live stream, see if it worked. The audio actually worked this time because last time I couldn't figure out why the audio wasn't playing. So that was beautiful to see. I want to thank you guys for being here, but please join me tonight at 8:50 p.m. We have a lot more to discuss about this. He was using those big words, exactly. And so thank you so much, Moses Tillman, for being here in the early bird special. Auntie Val, Professor Auntie Val, thank you so much for chiming in, and everybody else that watched. Please smash the like button. And please also, if you like what we're talking about, we have a lot more to talk about, and hit the subscribe button and then click the all notification bell. That's so you get the notifications. I'm just going to tell you like it is. We have 14,000 subscribers, and I want to thank each and every one of you. But unfortunately, in my back office, recently, it just showed that they only send out notification to 2.2 thousand people. So 14,000 subscribers, but only 2,200 in the most recent upload was sent out notifications. So 12,000 people don't even know if this live stream is going, doesn't even know that I upload videos. I'm incognito. All right, just letting you know. So therefore, that's why you have to hit that, and then down below, sign up, connect with us on Instagram, TikToks, Facebooks, all of that. Down below at the very bottom is that connect with us links. So hopefully that helps out, and I want to thank everybody for being here. Please join us tonight at 8:50 p.m. And if you can't, please join me on Friday at 9:10 p.m. Eastern Standard Time, and maybe I'll have some more early bird special videos because you never know what's going to come up in this day and age. But I am actually going to play something because people aren't familiar with what we do around here. I'm going to play SSN Lifestyle, some item. Let me go do a promo, shall I? Here we go. Come on. All right, ladies and gentlemen, just a little something just to let you know we get around, and therefore that's what SSN Lifestyle is actually all about as well. So go check out the links. I have plenty of links down below, whether you want free stocks, whether you want to find out about business opportunities, it's all down below in the description because you're going to have to be making moves. You can't rely on the status quo. All right. Even Airbnb is going to have a problem. All right. Even Amazon is going to have a problem as far as revenues come in. That means people that rely or use them to make money, you may have a decrease in profits this year. Of course, there's always winners. There's always winners, but there's going to be more losers, or shall I say, not losers, but more businesses that make less money. Just like you're seeing in the stock market. Doesn't matter if you're Apple, if you're Microsoft, if you're Amazon, if you're Tesla, it does not matter. You could have decreases in revenues quarter over quarter due to you need customers to be making money in order to buy items. And if your customers aren't making enough money and they're getting squeezed, then their discretionary income they're not going to use. They're going to actually save it and sit there and go, wait, my bills might be X amount, so I better save this money. So that's what you're going to have to be dealing with over the next 12 to 16 to 18 months. Just keep that in mind, ladies and gentlemen. Don't be out here sloppy. Now, if you want to win some free tickets to the Coke 0400 and the Wawa 250 2-day tickets, and they include Fan Zone 2 Fan Zone tickets, then you got to sign up as a referral affiliate or a member of SSN Lifestyle. And just straight up, whoever has the most sales for the next 3 weeks, you're going to win the tickets. All right. There will be a leaderboard probably starting in about a week, but that's who's going to win. There's going to be other prizes as well, but you're going to have to submit people into buying products from the shop. And it can't be the 5,100. All right. It can be signing up additional memberships. All right. But the 5,100, that is not included. The 5,100 passive income where you can earn 5% to 0%, not included because that's not commissionable. Only items that are commissionable. The tickets to the Punta Cana conference and party, that's not commissionable. So therefore, you can't get any points if somebody signs up and uses your link for that. It's not commissionable. All right. So just keep that in mind. Things like that are not commissionable. So you will not get any points, but you get points for everything else, for products, for services, for vacation rentals, all of that. You get somebody to join in for the fun, and you can get tickets. There's going to be more added, by the way. That's just the tip of the iceberg. I might be able to talk about it. And oh, by the way, if you're new here, we're going to have group economics at SSN Lifestyle, and SSN Nation knows about it first. So you guys, we have business opportunities like rental management company in Punta Cana because they're creating 50, 60, 70, 100,000 condo projects there. Over in Punta Cana region within 45 minutes of each other. That's how many units that's going to be available. And out of all that, not all are going to be, but there's going to be thousands of people looking for rental companies. And most people are charging 30% right now. We're trying to do 20%. There's also fingernails to go business opportunity that's going to come. And that's actually a countertop unit. And then we have people that go around and we have profits coming in. You get to receive passive income for that. The rental management, passive income for that. Then you'll have an option to get into a business opportunity where it can be, I don't want to say pre-IPO. The thing is, it's shares of a company that is not on the stock market. They have people saying, of course, how it always works. If you have shares and you're with a big time company, have partnered with a big time company, then talk of an IPO down the road. That could be a year from now, 2 years from now, 5 years from now. But as a person in SSN Nation and SSN Lifestyle, you'll be able to invest and get some shares that could potentially be 10 cents, 50 cents, $1, whatever it is, before the venture capitalists get in. And there's a company right now that you guys are positioned for, but you don't know it yet. But there's a company that venture capitalists want to invest in. They've already said, we want to invest. I'm trying to get the owners to give us here in the SSN Nation and SSN Lifestyle the first opportunity so we can get the pre-shares before the VCs get in, because once the VCs get in, then we're back to the old $250,000 net worth or $1 million net worth, have to show us $250,000 kind of nonsense. Accredited investor, right? You guys might have heard that before. You know what? I'm going to talk about something tonight, but I just want, hold on. Let me show you guys something. In fact, let me, because it all depends on the fund, but I'm going to show you something else before we go. Because of course, it's always a learning experience around here. let me pull this up. Okay. Where's my Investopedia at? Here we go. Is that my Investopedia? Here we go. All right. Where's it at? Here we go. To become accredited, certain criteria must be met, such as having an average yearly income of over 200,000 or working in the financial industry. There you go, ladies and gentlemen. 200,000. I always say 250 because some of the things I see says 250, but 200. It doesn't matter. Not household income, like the government tries to fool you, saying, "Oh, the average wage is," and then you see a blurb saying that's the average household, meaning two people make, $60,000 a year. Okay, that's great. It's not one person making 60, which makes it worse that they're talking, and then they say household. So here is 200,000. You know how many people make $200,000, ladies and gentlemen? This puts people in the top 1%. So that's why the rich keep getting richer, because they're able to get in on these pre-IPO deals. And you guys might have an opportunity. Like I said, this is big time. I'm very, very happy about it. This is big time, and you guys are going to have it. The Ring of Fire is what it's called at SSN Lifestyle. You have to be an SSN Lifestyle member. You can't be a free referral affiliate, which is a free offering that we have where you can refer people, but you do not receive any membership benefits. In this case, Ring of Fire is only open to members that are paying members of SSN Lifestyle. More benefits are coming for SSN Lifestyle, especially the premier level, which also means that the Founders Club level is going to get an additional benefit added to theirs. Because remember, Founders Club, there's only 15 of those available. They're exclusive. And remember, also, they'll have every membership benefit and more. So if Premier or Pro or Elite benefit gets added, that means it gets added to the Founders Club automatically. And it gets added to everybody up the chain. But in this case, Premier gets something added. That means Founders Club gets something added. Elite and Pro members get nothing, no benefit added because it's a higher level. So just letting you guys know, stay on top of it. Things are coming. Things are happening. Get your investment dollars. Make sure you have that big bag of cash ready. All right. So I got to get out of here right now, but I want to thank you, and hopefully I'll see you tonight at 8:50 p.m. where we'll have our actual SSN Nation Wednesday night live stream where members with the icon can be in the chat room. So thank you so much again, and I appreciate you guys being here this afternoon. And with all that said, please keep your head up, keep moving, and I'm out.